Hello students. Yes, so today in this video I'll be winding up with the last a type of money market security, that is call money, which is basically called as call money market. So what is this call money market is all about? See, this is a market where the call funds are borrowed and lent. Now, what does it talk about? See, a call money market is definitely an essential part of the Indian money market, where the day-to-day surplus, that is the funds mostly of the banks that are traded, the money that is lent for one day in the market, it can be termed as the call money market, where the call funds, it includes very short period funds such as money at call and at the short notice. What you will have to understand now, see, there is something called as call and notice money. What does it talk about? See, call money market, it deals in a very short period of funds. The period ranges from overnight to a fortnight, whereas call money is repayable on the immediate next working day. Notice money is repayable within a fortnight, and these transactions are not covered by any kind of collateral security. I mean to say, these particular, that is under call money market, you will not find any kind of collateral securities attached with the transaction, and it is sensitive segment also. See, any change in the demand or in terms of supply of short-term funds in the financial system is always like quickly it is reflected on the the money rates which is associated with the call money. So there are some kind of benefits which is associated with the call money market, that one thing, there's a quick fund, and this is one of the best a kind of, what do I say, an ideal optimal decision where you can go ahead with the investment, the factor of profitability. So to understand that how this particular call money market has come into existence, see, although call money market became operational worldwide after the First World War, there were only few participants, like it can be the rich individuals or the foreign exchange banks who took place. See, the call money market in India, it was operationalized with the inauguration of RBI during the year 1935, with the banks taking part in that particular thing. Then what happened, from early 1970, the unit trust of India, right, and the life insurance company, they were all permitted to operate in the call market, but only as supplier of only the call loans. Then the SBI and its subsidiaries, it entered the call money market in October 1970, and at that point of time, the institutional investors were restricted, they were confined, they were prohibited from operating in this market as well. So there are several committees which always took about the operation of the lender and the permission to operate in the market. You have STC, and there are certain, like Sukhmoy Chakraborty committee was also held in the 1982, where the deregulation of interest rate on call loans were taken care, and it was like those involving banks, like transaction conducted over the telephone, and the lender issues an through the RBI check in favor of borrowing the bank, which is like acknowledged by call money borrowing receipt. On the reversal day, the borrowing bank it repays the amount with interest by issuing the RBI check, and the tender returns the duly discharged receipts as well. That's how the things were going out. And coming to the call money rate, how does it work? See, the rate of interest on call loans is called as call money rate. So the rate of call money, it is like strikingly varying, and it is very volatile, and the reason, because there are factors like inflation, there are factors like a deflation, purchasing power, right? All these things matters, because we have a concept of time value of money, like how over a period of time the value of your time, whether it will increase or it is going to decrease. So the factors, what you have is a CRR. CR is nothing but cash reserve ratio. What does it talk about? Where the commercial banks, out of the NDTL, that is net demand and time liabilities, the commercial banks are going to keep 3% of the funds which are acquired, isn't it? So that matters a lot, and there are fluctuating corporate demands also, right? And the volume of bank deposits, this you can connect with CRR. It all depends upon how you have accumulated the deposits in various forms, right? And what's the cyclical fluctuation, which is happening in the economy. All these factors, it actually plays a vital role in determining all this. So the loans under the, this thing of short term, duration varying, of 1 to 14 days are traded in call money market, and the money that is lent for 1 day in this market is known as a call money. And if it exceeds, like 1 day, if it exceeds but less than 15 days, then it is called as a notice money. So the term money refers to the money, the lent money what you have lent for 15 days or more in the interbank market, right? So this talks about how a money market is dealt and what are the things, how it is going to run under call money market. So to sum up, what is called a money market? It is a money at call where it is said to be the short term financial loan. That's the reason why it is segregated under the security, money market security. And where a short term financial loan, it is payable immediately and it can be in the full as well when the lender demands it, unlike a term loan, which has a set maturity and payable schedule. Call money doesn't have any such fixed schedule as such, nor does the lender have to provide any kind of advanced notice over here. So how it is all going to work? It is short term in nature. Call money, interest paying loan from 1 to 14 days can be happen, that can be made by a financial institution to another financial institution. And due to short term nature of loan, it doesn't feature any kind of regular principal and interest payments, which longer term loans might, right? So the interest charged on a call loan between the financial institutions is called as call loan rate, right? So what you have to understand here, call money is something, it is a type of short term security. Interest is earned, the financial loan that the borrower has to pay back immediately whenever the lender demands it. Fine. Then it allows banks to earn interest, which is known as call loan rate on their surplus of funds. And call money is typically used by the brokerage firms for short term funding needs. All right, so this talks about the call money and what can be the advantage. The most important component is that as an extremely short period funds management, it can be hold, and there's a liquidity, that is easily reversible transaction is also there. That's how the things are going to work with the call money market.